we are going to take a look now at this company, seeing that they just had earnings today. And guys, when it comes to this company, this one is very, very interesting to say the least. This is a company that, well, has a massive peak. Seriously, $400 peak, which is just unheard of. And if you guys take a look at the current price, it's sub 100. In fact, at one point today, prior to earnings, or at least even yesterday, they were at, like, if I'm not mistaken, I believe they were what, sub $90. So yeah, now they're up a massive amount today. As you guys can see right over here, 12.76%. So you guys can tell that they had a pretty good earnings, but just based off of this graph alone, 153 in July 31st, massive crash, and then their lowest point was 79.86, guys. Peak up, or at least peak in the 52-week range, $157. Now, if you guys don't believe me, look at this thing on the 5-year. Almost $500 as of October 29th, 2021. And yeah, if I would have done an analysis, I wasn't doing any videos, I believe, back in 2021. But if I was doing an analysis at this point, a lot of people would be like, this thing would never fall down, because I would have said very, very expensive. But yeah, guys, from $500 to essentially to sub 80 just a few days ago, right? So I look at this, I'm like, this is a very much perfect example as to how a company, as to how you can overpay for a company, right? On the year to date, this thing is down 3%. On the 1 year, this thing is down 17.32%. Now, for all of those of you who may not know what Generac actually does, it's actually a really kind of cool company. Now, I did hear that they had a lot of controversies back in the day, but that's beside the point, right? I mean, Waste Management had a lot of controversies, and right now, they're one of the best companies out there. So when it comes to Generac, we can see designs, manufactures, sells, and power generation equipment, energy storage systems, and energy management devices and solutions, and other power products for residential, light commercial, and industrial markets worldwide. Basically, they make generators. That's really it. So, you know, I'm the kind of person that I would love to have like my own kind of just like off the grid kind of living, you know, but still have like solar panels and still be connected to the internet, but not be fully attached to like the sewer system or like the power grid or any of that stuff. I'm not really a fan of that. When it comes to this, I'm just like, yeah, I really do like this company. So let's take a look at what they actually did when it comes to their earnings. We got Generac non-GAAP EPS of $1.64, beats by 13 cents, revenue of $1.07 billion, beats by $30 million. Okay, all right, so we got over here revenue of, look at that revenue, that's a drop on the year-over-year revenue of 1.8%, even though it was a beat. Residential product sales declined 15% to $565 million as compared to $664 million last year. Commercial and industrial product sales increased 24% to $385 million as compared to $311 million the prior year. The company is maintaining its overall full year 2023 net sales guidance for a decline of approximately -10% to -12%. I love how their forecast, it is a decline, right? That's, or at least their full year guidance, right? It's still a decline. So that's not necessarily something you want to see, though. As compared to the prior year, which includes approximately 2% of the net favorable impact from acquisitions and foreign currency. Additionally, the company now expects net income margins before deducting non-controlling interest to be approximately 5 to 6% for the full year 2023 compared to the prior guidance range of 6 to 7%. The corresponding adjusted EBITDA margin is still expected to be approximately 15.5 to 16.6, in line with the previous guidance. Operating and free cash flow generations are expected to return to strong levels for the full year, with conversions of adjusted. Okay, so yeah, they're not having too much of a good time when it comes to the cash flow. In fact, we're going to take a look at that when we take a look at the graphs. But that's essentially their highlights when it comes to their earnings. Now, Generac stock surges on better than forecasted earnings. I love it because they were expecting a whole lot worse, and even though it wasn't, that's why the stock is up right now a whopping 12.5%, and I think at one point it was up even higher. I mean, if we take a look at this on the 1 day, this thing was up to $97. I think it was up like 13% when I saw it. So there you guys have it. There you guys have it. Now, let's jump into the actual earnings report, and let's take a look at the PDF version for this, just because it's always a lot easier to take a look at. And for any of you guys, of course, wanting to take a look at this, link is in the description below. Okay, so we got over here return to margin expansion and strong free cash flow generation, maintaining overall net sales and adjusted EBITDA outlook for fiscal 2023. We already read most of this. Well, actually, hang on a minute. We read most of this, but we didn't read this part. Cash flow from operations was $140 million during the third quarter compared to the negative $56 million the prior year. So there you have it. Yeah, they did negative free cash flow last year. And right now, even though they're not doing too hot, you guys can see they are bringing it back up. Free cash flow, as defined by the accompanying reconciliation schedules, was $117 million compared to the negative $73 million in the third quarter of 2022. During the third quarter of 2023, the company repurchased 875,580 shares of its common stock for $100 million under its current share repurchase program. There's approximately $178 million remaining under the current repurchase program as of September 30th, 2023, so we can pretty much expect them to continue buying back shares. Now, taking a look at what the CEO actually had to say. Quote, our results in the third quarter reflects improving operating performance and validate the longer-term focus on our Powering a Smart World strategic plan, said Aaron Jagfeld, CEO. We experienced a strong sequential increase in shipments of home standby generators during the quarter as high activations are driving field inventory towards more sustainable levels. In addition, in-home consultations for these products also remain strong during the quarter as category awareness continues to increase in the back of well-publicized grid stability concerns. Additionally, CNI, which is we kind of just read this here. What was it again? Commercial and industrials. There we go. So when it comes to the commercial and industrial product sales, continue to experience significant growth over the prior year. Now, once again, exceeded our expectation. We also saw margins expand year over year and generated substantial free cash flow during the quarter, both of which are expected to continue in the fourth quarter. Now, let's take a look at the outlook, which we kind of just saw. We're expecting the decline to be around negative 10 to negative 12%. Compared to the prior year. Additionally, the company now expects net income margin before deducting any non-controlling interest to be approximately 5 to 6% for the full year compared to the prior guidance of 6 to 7%. So that went down. Okay, so they were expecting an EBITDA before of 6 to 7%. Now they're expecting 5 to 6. The corresponding adjusted EBITDA margin is still expected to be approximately 15.5% to 16.5. We already read that. When it comes to that, we already read that too. When it comes to the cash flow, and yeah, that pretty much does it for this, guys. So yeah, they have problems, right? They really have problems, especially last year. But all in all, they seem to be increasing, which is a great sign. Now, I do have the calculator over here, guys. So let's take a look at this. We got the ticker for GNRC, market cap of around 5.91 billion, with a PE of 39.67 and a current share price of 94.59. Maybe they took a look a lot at this share price. I mean, when this thing falls from 500, right? When you're $2 up from 500 in October of 2021 down to sub 100. Yeah, this is, again, a prime example as to how you can overpay for growth. So it is what it is. They don't pay the dividend, which means all of this free cash flow is going straight into themselves. As you can see, 5-year average free cash flow being $229 million, whereas last year's free cash flow, negative $28 million. Taking a look at these fundamentals, let's take a look at the net income. 5 years ago of $238.3 million, 1 year ago of $399.5 million, increase of 68%. You can see here that this is an outlier 2 years ago, but overall, after coming down last year, we can see that this is coming down to the mean. Now, I am really curious though. Do they mention? Oh, here we go. I want to see the net income if possible, right? Let's see. Do we not have net income right over here? So we could see, let's take, okay, so this is on the 9-month ended. This is the 3-month ended. Net income is pretty much remaining the same, right? At least on the 3-month ended. And it's a massive drop on the 9-month ended. Wow. That's a massive drop, right? That is the net income. That's a massive drop, guys. You can see from 335. Is this in millions? This is in thousands. Okay. So this is in thousands. So this would be 335 million to now 120 million. Wow, 120.3 million. So that's a big drop right there. So coming back over here, I don't know. I'm curious. What does Seeking Alpha say that their trailing 12 months is right now when it comes to the net income? And we can see that that's a massive drop. right? There's no way that they're going to be able to make up this. So right now we're seeing a massive decrease when it comes to the overall net income for the past 1 year ago, especially this year. So I'm gonna have to say, guys, like a 40% or so on this one. All right, free cash flow. 5 years ago of $199.6 million to 1 year ago of negative $27.7 million. We already saw this, right? They kind of expected it. However, as of today, their free cash flow, as they said, right? As they said in their own earnings, if we come back over here to the free cash flow, yeah, their free cash flow, it is a positive 117 million compared to negative 73. So there you have it, guys. Their free cash flow is doing a whole lot better, even though this is a negative. And it's, I'm going to say acquisition. So outlier, we already know that this is doing a whole lot better. I'm very, very curious. Let's take a look at now the free cash flow trailing 12 months. So you can see right over here, it is, oh man, hang on a second, just so that way I don't look like a fool. Let me get out the calculator. So we got 109 minus 93.6, and that is $15 million. And we still have a quarter to go. With the $15 million, this doesn't even get close to that, but at least it's heading back in the general direction. Therefore, I'm gonna have to give this like a 50%. I give this thing a 40%. Yeah, you know what? I'm gonna give this thing a 50%. It's not good, but it's just, it could be better. When it comes to the revenue, 5 years ago of $2.02 billion to 1 year ago of $4.56 billion, increase of 125.6%. Nice continuous increase, a little bit of a jump right here from 3 to 2 years ago, but overall not too bad. I'm gonna say like a 95% on this one. When it comes to the assets minus the liabilities, once again continuously increasing, a little bit of a jump right here from 3 to 2 years ago. Average total assets being $4.25 billion with liabilities of $2.33 billion. And a difference of almost $2 billion. This isn't looking too bad either, guys. I'm going to say it once again, 95%. Cash flow minus the liabilities, it's weird because you can see that from 5 to 3 years ago, kind of remaining the same, the massive drop afterwards. I mean, 1 year ago, they're negative $3 billion, the average being negative $1.84 billion. I'm going to say roughly at like, I'm going to say like a 30% on this one. Shares outstanding. Now, these shares outstanding are incredible. 5 years ago of 62.1 million shares to today of 62.2 million shares. You can see that they had a little bit of an increase right here from 4 to 3 years ago during COVID, and then from 3 to 2. But then they bought back 1 year ago, going from 63.7 to 61.4, and then they increased it. This is like just on average flat, right? So overall, I like it. A little bit of increasing there. You could say, yo, they increased it because 2 years ago, their freaking share price was $500. Yeah, I wouldn't do it too. So you know what? I'm going to say, guys, I'm going to say 100% on this one. I really do think that that's 100%. And lastly, cash equivalents, they currently hold $193 million with an average of $279.22 million. Overall grade, I give this thing a 67%. It barely makes it there. The biggest issue is the net income as well as the free cash flow. Free cash flow, we can see that they are increasing it. However, the net income is just, it's lagging behind, guys. It really, really is. Now, here's the thing. What price should we pay for this? Because clearly it was not $500. And if I would have done this analysis, whatever number we get over here, most likely it's going to be lower. And to all of those of you who might say, it'll never fall there. It fell from 500 to sub 100, guys. Yeah, it can absolutely fall more. So let's take a look at this company now, and let's see whether or not at the current share price, this is a buy. So yeah, take a look at this, guys. Looking at this now, we got $94.59, $24.36, not adjusting for debt, and adjusting for debt, $2.59. Now, when it comes to the projected share buyback, I'm gonna say negative 1%, 0, because let's face it, that's kind of fair. Actually, that's technically the right answer, and then 1%. Now for the revenue growth assumption. Taking a look at Seeking Alpha, we're expecting Generac to be 5.35% and sector median 7. And if we take a look back at this, they went down 1.8. So I think I'm going to follow more along this line. So I'm gonna go, let's see. I'm gonna go 4%, 5%, and 6%. And with that, guys, we get $27.79 to $30.38, and then adjusting for that, $6.23 to $8.38. I'm gonna say to 5, 10, and 15, $5.30 to $8. Yeah, it's expensive still, guys. I understand that, you guys are looking at these numbers and just like, it'll never fall to $30. Well, I mean, for all of those of you who are probably just joining right now, let me take you back to October 29th, 2021. $498.56. Current price, $94. I get that right now it's had, $12.14%. It's still expensive, guys. It really, really is. Now, you can make the excuse, or I guess another, you can make the argument that, sub 80, sub 90, it's looking like a better buy. But I look at this and I'm just like, it's still, from what you're getting, it's not really that impressive. Right? From what you're getting, it's not really that impressive. So, yeah. My 2 cents on this is just that they don't pay out the dividend, so we got nothing there. So, yeah, guys, Generac, it's a company that I would love to buy. It's still looking a little bit expensive for me. It really, really is. But do with that information as you will. So, yeah. That pretty much does it when it comes to analyzing Generac from a fundamental perspective. So thank you so much for watching, everybody. Make sure to like, subscribe, comment. It really does help here with the algorithm on YouTube as well as Rumble. And, we are live streaming right now. So if you guys missed the stream, you guys can watch the VOD. But you are getting this video for the 2nd of November at 4 o'clock. So thank you so much for watching. Peace out, and we'll see you all next time.